Everyone loves getting paid pretty often. So we have QLDY, and everyone is wondering where exactly are the distributions? It's been out since September 17, 2025, and we have not yet received any distributions, even though this has been trading for a little over a week now, almost 2 weeks, with nothing in return. Now, this is going to be pretty normal. Usually it takes a while for these distributions to actually come to effect. And this is going to be the same case. So we do have to wait a while. We're going to go into when they're actually going to start paying out, and we do not know exactly how much. So we head over to the website. Now, no information on the distribution rate. The distribution rate is actually going to be 2 times a week, not actually monthly like this website says. And we will go over how exactly they're generating their income and what actually they're doing inside this ETF. So a brief overview of QLDY. It's a game-changing ETF. It pays out 2 times a week, which is the most frequent payer out of any single ETF or stock. Now, we're going to be seeing a lot more of these style of ETFs as many people, a lot of retail investors love getting paid as frequently as possible. It's just going to put more money in your pocket more often. You can use that income for your expenses, especially since a lot of people are living paycheck to paycheck. They want to have that money readily available to pay off any bills, any debt, or what have you. So what the strategy is, it's called the NASDAQ 100 Lightning Spread Income ETF. Pretty unique name because it's going to be doing 2 times a week distributions. So it's going to seek frequent income, maintaining the opportunity for indirect exposure to the performance of the NASDAQ 100 index. So what you're going to get is synthetic equity exposure. So it's going to have LEAPS options, which if you're not familiar with, it's deep in the money call options with a long dated expiration date. So it's going to mimic the exposure of the NASDAQ 100 index. And that's pretty good. A lot of people love those single stock ticker ETFs. Personally, I'm not a huge fan because it's a little bit riskier, but you are going to get more volatility, more income from single stock income ETFs versus an index like this. But I personally love when it's a little bit more diversified, and doing a strategy like this on the index should help stability, hopefully. We don't know if it's going to have any NAV stability or some severe NAV erosion, which in the past, Defiance ETFs used to have a lot of NAV erosion. And it's going to generate that income through the daily sale of 0 days to expiry put option spreads. So that's how they're going to be able to pay twice a week. It's because they're going to be making income every single day by selling options, very short dated, basically opening and closing it the same day and not really holding any options overnight, so you don't get any of those major volatility swings. And in my opinion, this is a pretty good strategy. We've seen this strategy with other ETFs. We've seen it with QDT, which is going to be the Round Hill 100 0 days to expiry covered call ETF, but instead of put spreads, you're going to have a covered call strategy, which is going to, of course, cap your upside potential, but it is 0 days to expiry, so it's not holding anything overnight. And the Round Hill Innovation 100 ETF has performed very well, pays out weekly, and has a pretty high dividend yield of over 30%. Now, in terms of distribution rate for QLDY, what can we expect? Well, as we mentioned earlier, it hasn't paid out its first distribution. Let's go over when it's actually going to start paying. So we head over to the 2025 distribution schedule on their website. We can see that it's going to start paying next week, which is actually going to be the first Thursday of October 2nd. So mark your calendars. That's going to be the first distribution, but be careful. We don't know if this first distribution is going to have 2.5 weeks of options inside of it, because this ETF has been trading since September 17. So about 2.5 weeks of distributions could juice up that first distribution and be a little bit misleading. Now, another strategy they could do is they could hold some of that profit they've made from the options income in return for paying out a steady dividend. It could pay out a lower one than what they actually made in order to preserve the NAV. So the October 2nd, 2025 is a Thursday. It's going to pay every Thursday, and then we can see the next pay date is going to be October 6th, 2025, which is going to be the next Monday. So it pays every Monday and Thursday. So it's a very unique ETF. Not many ETFs pay out on a Monday, so we're going to have another option for that day. It kind of makes Mondays a little less terrible from the long weekend. So it's very good to see that people are coming out with these ETFs that pay out on Monday. So it gives people something to look forward on, especially since that's a day where people go back to school or go back to work. And Thursday is also a pretty unique day as well, since most ETFs pay out on a Friday or even a Wednesday. Now, if we take a look at their prospectus filing that they have filed all the way back in May of 23rd, 2025, we can see that they're also coming out with two other ETFs. Same strategy, but different indices. So we have the Defiance S&P 500 Lightning Spread Income ETF, SSOY, and we have the Defiance Russell 2000 Lightning Spread Income ETF, IJRY, which are going to be the same strategies, paying out 2 times a week and doing 0 days to expiry, put spread options on the underlying index. Now, of course, I do think that the best one out of these 3 are going to be QLDY. I'm not sure why this one was released way ahead of the other ones, but 2 or more are on the way. And I think the NASDAQ 100 has a really good balance of diversity within 100 companies, but also providing enough volatility that you're going to get a very good distribution rate. Now, if we do the same strategy, if they do the same strategy on the S&P 500 index, it's going to be more diversified, a little more stable, so you're not going to get as much income, and that could be a good option for a lot of people who want something that's a little bit more stable, don't want as much volatility. S&P 500 is going to be a good pick. Now, the Russell 2000 is going to be small to mid-cap stocks, and even though there's 2,000 of those companies, it is going to be a little bit more volatile because those small companies, they do have a lot of volatility with them. And most of the time, a lot of them actually end up dropping in share price. So you do have to be careful of that. But in my opinion, the 2 that you should look after would be the QLDY for the NASDAQ 100, as well as the S&P 500 SSOY for your portfolio. And I'm really curious to see what other ETFs are going to follow this trend of trying to pay out as frequently as possible. Are we going to see something that pays out 3 times a week, Monday, Wednesday, and Friday? That would be very interesting, and it would definitely set a new precedent for ETF issuers going forward. Now, of course, the only way they can pay out this frequently is through option income ETFs. A normal company, a normal ETF would not really be able to do this without some active trading. And we have to go over the management fees. We can actually see, we take a look at the fund details, the expense ratio is going to be 1.04%. So it's quite high. And if this is a flop of an ETF for whatever reason, we could see some significant erosion due to that very high expense ratio. But all of these income option ETFs are actively managed. The fund managers have to trade every single day. So that's why we have a very high expense ratio. It's kind of a trade-off because a lot of people, they are used to trading their own options. Or if you're not familiar with trading options, you would buy into this ETF, have a professional do it for you. And it also saves you that time commitment where you have to wake up pretty early. If you're on the West Coast, you have to wake up at around 6 o'clock for the market open, which is quite early. A lot of people don't want to do that, and it's better just leave it to the professionals. Now, those on the East Coast is a little bit better. They start trading at around 9:30 a.m., so their sleep schedules are actually a bit better, but it is a time commitment. A lot of people don't want to watch the market 24/7, so they can get on with their lives, whether they have school or they have work. They don't want to constantly check and worry what exactly the market is doing and manage their positions pretty much every single hour of the day. That's not something people want to do. I would like to know what your thoughts are on QLDY. I know it's very interesting. There's pretty much no history with it or history with any other competitors. There's nothing like this ETF 2 times a week is very unique, and I think that either they're doing just purely for marketing, getting assets under management, or is this a viable ETF to buy and hold for your portfolio for income 2 times a week? And competitors for this ETF would probably be, as mentioned earlier, it would be the Roundhill Innovation 100 0 days to expiry covered call ETF QDTE, or even the one by YieldMax. But these are covered call strategies. They're not put spreads. So it's a little bit different, but it is doing the 0 days to expiry on the NASDAQ 100 index. And these have performed okay because it has a covered call strategy. The upside potential is a little bit capped, but you're getting that weekly income, and it's been pretty reliable, especially during bull or flat markets where it really shines. And if you're not familiar with the underlying strategy, which is put credit spreads, 0 days to expiry, you're probably familiar with the Z0DTE. It basically expires that same day, and they're able to do that on the NASDAQ 100 index. But they're basically buying and selling a put option at the same expiration date, as we can see here. So we basically want the stock price or the ETF price or whatever underlying there is to stay above the leg of the put option. So if we head over to Robinhood, we can actually construct an example of what it would actually look like. So head over to the options chain on whatever brokerage you have. In this case, I like to use Robinhood because it's most visually appealing, very simple to look at, and pretty easy to understand. So head over to sell put, and then we'll just do a random expiration date. We'll do September 29. And then we can just scroll down and choose one of the options. So for this example, we'll just choose the 594, sell that, and then you want to switch over to buy and put, and then buy the one underneath or another one. For this example, we'll just choose the 593 strike, and here we go, a put credit spread. You're going to receive $21 for opening it, and basically when you lose, it would be if the underlying, in this case QQQ, goes below both of your strikes. And the max profit is going to be the credit you're receiving, while the max loss is going to be the difference in the strike prices, which is going to be $1 multiplied by 100. It's going to be $100. And then the max loss is actually a little less. You have to subtract the 100 by the credit you're receiving. So in this case, it'll be about $79 for a max loss. But it could be kind of complex for a lot of people who aren't familiar with options. That's why we buy these income ETFs in the first place. Let the professionals do it. They probably know what they're doing. And if these ETFs don't even perform well, they're going to lose money because less money for the management fees. So they do have their incentive to perform well, make their best calls that they can. Otherwise, people are just going to sell this ETF, move their money into another competitor. And that's what YieldMax is actually seeing. They're seeing a lot of competition from other ETF issuers, and a lot of people are moving their money from YieldMax, where you're seeing capped upside potential. A lot of people want some upside with that income into some other ETF issuers such as Roundhill, Defiance. We have Vista shares, and YieldMax really isn't happy about that because they are losing market share. But competition is really good for consumers or retail investors because we're getting the best products possible in order to gain our money, basically. So let me know down in the comments, are you interested in QLDY? Have you already bought it? In my opinion, it'd be best to wait maybe until the first distribution or even the second one, kind of see what happens with the share price after each distribution. Is it even going to recover its NAV after it pays out its distribution? We will have to see, but I think that because it's paying out quite frequently, we are going to get smaller payouts in terms of dollar amount, which could help with the stability of the NAV. And I'm hoping it's not going to pay a crazy dividend yield. I don't think it will because it's not using any sort of leverage. But if it has a crazy dividend yield, it looks attractive on paper, but you're going to see some significant erosion in those cases. And that's why I prefer something stable. NEOS ETFs have figured this out. They pay out pretty modestly, 14% for the QQQI high income ETF. And in return, we're seeing some good stability with the NAV. And NEOS is coming out with some great products. They're having their boosted ETFs coming out. They're having their own OT clone. So a lot of great products from NEOS. Make sure you stay followed for those.